Hello everyone, welcome back. And it's only been a few trading sessions since gold and silver started pulling back, but already the same question is being pushed everywhere. Is this the end of the bull market? Or is this just the market doing what strong markets do before the next major move? And today is Wednesday, May 6th, New York time. Before we get into it, comment below what day and date you're watching from, because these markets are moving fast, and that matters. Also, if you value this kind of breakdown, support the channel by subscribing and commenting Arjan AG below. That tells me you're here for calm analysis, not panic. So in this video, I want to make sense of why gold, silver, platinum, and palladium have been falling, why that does not automatically mean the bull market is over, and why investors need to separate realistic risk from extreme fear. Because yes, depression and hyperinflation are possible in theory, but building your entire financial life around the least likely outcome can be just as dangerous as ignoring risk completely. Now jumping in, the first thing we have to understand is that a falling price is not the same thing as a broken trend. Gold has had an enormous run. Silver has had an enormous run. Platinum and palladium have also moved into levels that, compared with most of the last decade, still look very elevated. So when prices fall hard after a major advance, the question is not, did the price fall? The question is, what kind of selling is it? Is it panic selling because the story changed, or is it profit taking after a crowded move? And based on recently published numbers, the second explanation makes a lot more sense right now. Gold has been trading around the mid $4,000 area, silver has been holding in the low to mid 70s, platinum has been hovering near the high 1,000 range, and palladium has been sitting around the mid 1,000 range. Those are still big numbers. So when people say metals are collapsing, we need to ask, collapsing compared to what? Because if gold pulls back from an overheated level, but remains well above where it traded not long ago, that's not a collapse. That's a reset. And resets are uncomfortable because they happen right when the emotional crowd starts thinking prices can only go one way. Now in silver, this matters even more. Silver is famous for shaking people out. It can look powerful one week, weak the next week, and then suddenly turn around before most people have finished explaining why it was supposed to keep falling. So yes, a deeper correction is possible. It would not shock me to see silver test lower levels if traders keep reducing risk. But a correction inside an uptrend is very different from the end of the uptrend. And this is where many investors get trapped. They hear a scary headline. They hear someone yelling that the whole thing is over. And instead of looking at the actual structure, they react to the noise. But here's the part that deserves more attention. Precious metals don't usually move higher in a straight line once the easy momentum gets exhausted. They climb, pause, scare people, consolidate, and then decide whether the larger demand story is still there. Right now, that larger demand story has not disappeared. According to the latest publicly available filings and market updates, central banks were not broad net sellers of gold in the first quarter. That claim has been floating around, but it confuses a monthly selling pocket with the full quarterly picture. The cleaner version is this. Some official sellers did show up during the quarter, especially during a volatile month, but the overall official sector still added a large amount of gold on a net basis. And that distinction is critical, because if central banks were truly walking away from gold, that would be a very different story. But if they are still adding, while some countries sell for liquidity, currency management, or internal reserve reasons, then the bigger reserve diversification trend remains alive. Now, does that mean gold cannot fall? No, absolutely not. Central bank buying does not put a magical floor under the market every single day. But it does tell us that the long-term buyer base is more serious than a lot of short-term traders want to admit. The same kind of confusion shows up in silver. High silver prices can reduce fabrication demand because manufacturers will try to use less metal wherever they can. That's normal. If an input cost rises sharply, industry looks for substitution, thrift, and delay. But at the same time, investment demand can rise because investors look at stocks, bonds, currencies, deficits, wars, and inflation, and they say, I want something outside the usual paper system. So silver has two forces pulling on it at the same time. Industrial users become more careful, but investors become more interested. That tension is exactly why silver can be so violent. Now let's talk about the delivery panic stories, because they come back almost every major silver cycle. People look at futures delivery, see big numbers, and immediately assume the exchange is about to break. But most of the time, the contract rolls, metal moves between vaults, and the crisis people were promised turns into a normal delivery period. That does not mean the silver market is loose. It does not mean inventories are unlimited. It simply means every delivery month is not automatically a default event. And if we confuse logistics with collapse, we end up scaring ourselves at exactly the wrong time. Now moving on to the economy, because this is where the metals story really gets interesting. The strongest case for gold and silver is not that the United States is guaranteed to have a depression tomorrow. It is not that hyperinflation is waiting around the corner next week. The stronger case is that the economy can remain functional while still producing enough instability to make hard assets valuable. Based on recent official data, real economic growth in the first quarter was around 2% annualized. That is not booming, but it is not depression either. Imports rose, and imports subtract from the GDP calculation, but rising imports can also tell us demand is still alive. Consumers are not acting like the world ended. Businesses are still spending. Government spending and exports also helped. The labor market tells a similar story. Job creation has cooled from the stronger post-pandemic period, and that matters. But unemployment is still just above 4%, which is not crisis unemployment by historical standards. It can weaken from here, and if it does, metals will likely respond. But the present picture is slowing, not collapse. Inflation is also misunderstood. The latest consumer inflation reading was in the low 3% area, with core inflation in the mid 2% area. That is still uncomfortable for households because prices already rose a lot in prior years, but it is nowhere near hyperinflation. And this is important because hyperinflation has a meaning. It is not just groceries being expensive. It is usually described as prices rising around 50% in a month. That is a completely different universe from the inflation problem Americans are dealing with right now. So when someone says hyperinflation, every time gas or eggs move higher, they may get attention, but they are not helping investors think clearly. That said, and this is the counterpoint, I also don't think investors should become too comfortable just because the extreme outcome is unlikely. A depression may not be the base case. Hyperinflation may not be the base case. But high debt, large deficits, sticky inflation, energy shocks, weaker confidence in currencies, and political dysfunction are very real. You don't need the financial system to end for gold and silver to perform well. You only need trust to keep leaking slowly. And that is the real world investors live in. This is also where the Treasury and dollar story needs balance. Foreign holdings of U.S. Treasuries recently sat near record levels, so the idea that the whole world has already dumped American debt is simply not accurate. But record foreign ownership does not mean there is no risk. It means the system is still functioning, while investors demand compensation for staying in it. The dollar has not vanished. Treasury markets have not disappeared. But purchasing power has been slowly eroded for decades. And every time deficits expand, investors are reminded that confidence is not the same thing as permanence. That's why gold and silver matter. Not because every scary prediction has to come true. They matter because even a normal-looking economy can quietly punish cash. Now, if we zoom out historically, the United States used to have far more violent economic cycles. Banking failures, weak regulation, financial panics, and old monetary constraints created downturns that were much more brutal than most modern recessions. After those crises, especially after the Great Depression, the country built stabilizers. Deposit insurance, central banking tools, unemployment insurance, Social Security, and emergency fiscal programs all changed the way downturns unfold. Those systems are not perfect. In fact, some of them are under strain. Social Security has a long-term funding gap, and the math eventually has to be addressed. But a funding gap is not the same thing as the program disappearing tomorrow. Again, probability matters. The same lesson applies to manufacturing. People often say America doesn't make anything anymore. But the better way to say it is, America makes a lot with fewer workers. Manufacturing output has been supported by automation, software, advanced equipment, and global supply chains. The problem is not only production. The problem is that production no longer creates the same number of middle-class jobs it once did. And that matters for metals because a country can have decent output, low unemployment, and still have millions of people feeling squeezed. That squeeze becomes political pressure. Political pressure becomes fiscal pressure. Fiscal pressure becomes monetary pressure. And monetary pressure is exactly the kind of environment where gold and silver keep attracting attention. So when we talk about the next few months, I would not be surprised to see consolidation continue. Gold may need more time. Silver may need more time. Platinum and palladium may also need to digest their moves. Markets often spend months frustrating both bulls and bears before choosing direction. But if the question is whether falling prices automatically mean the bull market is finished, my answer is no. Not based on the broader setup. Not based on official sector gold demand, not based on inflation still running above comfort levels, not based on deficits, not based on geopolitical risk, and not based on the way investors are still searching for alternatives to ordinary paper assets. What would change my mind? A real collapse in investment demand, a major and sustained reversal in central bank behavior, a dollar surge that actually tightens global liquidity for a long period. A sharp fall in inflation expectations combined with rising real returns on safe paper assets. If those things happen together, then yes, the metal story would need to be reassessed. But we are not there yet. So the practical takeaway is simple. Don't buy metals because someone scared you with the end of the world. Don't sell metals because someone scared you with a normal correction. Build your view around probabilities. Expect volatility, respect downside, but don't confuse a pullback with proof that the whole cycle is dead. And for silver specifically, understand that this market can punish impatience. If you're leveraged, every dip feels like an emergency. If you're holding physical metal with a longer view, the emotional pressure is different. That's why position size matters. Your strategy has to survive the kind of volatility that silver is known for. If you're successful, share your success story in the comments so others can stay motivated. And also let me know this. Do you think this metals pullback is just consolidation? Or do you think the market is warning us about something deeper? Because that answer matters. The indicators I would watch now are straightforward. Watch real yields, because gold hates being compared against paper that suddenly pays a strong return after inflation. Watch the dollar, because a stronger dollar can pressure metals even when the long-term case is intact. Watch energy, because oil can push inflation expectations higher and make central banks hesitate. And watch ETF flows, because when retail and institutional buyers move together, momentum can return faster than people expect. One more thing. A strong economy can still be bullish for silver if industrial demand holds, but a weak economy can also be bullish if investors rush toward hedges. That is why silver is tricky. It is part industrial metal, part monetary asset, and part emotional roller coaster. Never forget that combination. That is the challenge right now. As we wrap things up, remember that the middle ground is usually where the money is made. Not in blind panic, not in blind optimism. In the space between them, where the economy slows but does not collapse, inflation cools but does not vanish, and confidence remains intact but not unshakable. That is the environment gold and silver were built for. So take care of yourselves, take care of each other, leave a like if this helped, subscribe if you want more calm market breakdowns, and I'll see you in the next video. And just to be clear, this is my educational market commentary only. I'm sharing how I'm thinking through the data and the risks, not telling you what to buy, sell, or do with your own money.